caveat having been said, where do I think WTI is going to go? Quite honestly, I think last month's $32, the panic on the liquidation of the February contract, probably is not going to be taken out. I bet that that's going to be inviolate for a very long period of time into the future. So I think that 32 will be as cheap as you're going to get it. On the other hand, do I think that we're going to be rushing upward through $50 a barrel anytime in the very near future? No, not as long as, Jeff was absolutely spot on when he said what we really have to understand is that this is a diminishing of demand, not a diminishing of or an egregious oversupply. Demand is simply shrinking for the first time in a long period of time. And until the global economy turns higher and demand can be pushed up, or until there is some real active decline in production, primarily from the OPEC countries, and they're not going to cut production because they need cash flow. If you're Ahmadinejad, you have no choice. You need X amount of cash flow coming in, and I'm sorry, you need triple the amount of barrels sold at $35 as you needed at $135. So until demand picks up, crude oil is likely to remain under pressure. So where do I think crude will be 6 months from now? I bet we're somewhere $1 or $2 either side of $40 WTI or $45 Brent. Where do I think we'll be a year from now? I bet we're exactly where we will be 6 months from now. Where will we be a year and a half or 2 years from now? Maybe by then we'll start to see demand beginning to come in, and maybe by then we'll begin to see the market turn higher. Watch the contango. As long as there is a continuing widening of the contangos, as long as there is a market that tells you that it has to bid for storage, as long as there is excess supply out there and it shows up in the term structure, as long as that contango continues, I can't be bullish of the crude oil market. Does that mean I'm bearish? No, it just means I'm not going to be bullish for a long period of time. That was a long answer.
That was great, Dennis. Thanks. Jeff?
Well, I guess it basically boils down to where you think demand's going to be and supply is going to be in a month, 6 months, and 12 months. Those were the time frames. I think it's a pretty safe bet that demand is going to continue to contract, because when we're talking about oil demand, what are we talking about? We're talking about GDP. Our GDP is predicated on burning oil. That's as true of the Canadian economy, as it is of the Russian economy, as it is of the Indian economy and the Chinese economy. We have the deepest economic contraction since 1982, and maybe the deepest in the whole post-war period. Demand's going to continue to shrink. And if demand continues to shrink, oil prices are going to go down. And I certainly do not think that we have yet hit the bottom for global GDP, or for that matter, even North American GDP in the cycle. So I'd argue that we're going to see lower oil prices in the next month or two, 32, 33, 35. Somewhere in that range, if we have a deep enough recession, possibly even lower. But here's the thing. We cannot have an economic recovery, not here, not anywhere else, without a change in oil demand. If we're going to produce more GDP, we're going to burn more oil. It's that simple. And I think that within the next 12 months, we are going to see a turnaround in the economy. I mean, find a strong enough wind, and even pigs can fly. Force feed a $14 trillion U.S. economy with $2 trillion of fiscal stimulus, GDP will respond. That's not macroeconomics, that's arithmetic. What the long-run consequences of that are is open to debate, okay? So I would argue that in a year's time, we're going to see global North American demand turn around. But what's going to happen to the demand-supply gap? Well, the demand-supply gap next year is going to be tighter than it was in 2007, 2008, because while demand will ultimately recover, unfortunately, supply is going the other way. Unfortunately, the world will be producing probably 2 million barrels less per day of oil in 2010 than it is right now, because all of the new sources of supply, or the vast majority of new sources of supply that we thought we're going to bring on stream in the next 4 to 5 years, is not going to flow. It's not going to flow because the economics of that won't support it. And even if dedicated entrepreneurs are willing to go ahead single-handedly, they would be very hard-pressed to get financing to be able to bring that supply onto the market. So lo and behold, in 2010, we're going to find that we had a much tighter market than we ever had in 2007 and 2008. And you know, you don't need recourse to speculators to understand why world oil prices got up to triple-digit levels. I'm not saying that speculators weren't in the market, but the same factors that drew speculators to the market in 2007, 2008 is going to bring them right back into the market in 2010. Because what did they see in 2007 that made oil look like a one-way bet? I'll tell you what they saw. They saw a succession of world record oil prices not lifting a new single barrel out of the ground. That if you exclude natural gas liquids like butane and propane, and you look at the U.S. Department of Energy oil production numbers, the world was producing the same amount of oil in 2005 than it was out of 2008. And if triple-digit oil prices can't raise new oil out of the ground, what do you think the chances of $20 and $30 WTI or Brent has of raising oil out of the ground? So that looked like a one-way bet. And every day you're right as a speculator, you make money. What the speculators forgot, and other people like myself included, is 4 of the last 5 global recessions were caused by, guess what? Not Cleveland housing prices, but by oil. Oil has always been its own worst enemy. And what $147 oil gave us is the same thing as what 1973 and the 1980 oil shocks gave us, a huge, deep recession. And that meant that oil prices would fall. So I think that what we're going to see is, again, a spring back in demand just at the time when the world is producing less, not more oil. And if that isn't a recipe to bring the speculators back on board, I don't know what is.
Thanks, Jeff. And an important announcement, please turn off your cell phones. Industry estimates currently place OPEC compliance at about 68% of their announced cutbacks, with the Saudis potentially cutting more than their requirement. Is this level of compliance from the other OPEC members sufficient to avoid the wrath of the Saudis and a potential flooding of the oil market? Jeff, do you have any thoughts on that?
I wouldn't worry about any voluntary cutbacks from OPEC. I think they're incapable of voluntary cutbacks. But voluntary cutbacks is not the reason that OPEC exports are about 5 million barrels a day less than they were 6 to 7 years ago. It's not voluntary cutbacks that is going to be limiting their exports. It's 25-cent gasoline in Caracas and 50-cent gasoline in Saudi Arabia. And if you think that's cheap, you ought to see what they pay to generate power. Don't forget, in Saudi Arabia, all the power that is generated in the Middle East is done by burning oil and natural gas. They don't have coal, they don't have hydro, and we don't want them to have nuclear. So that means that they're burning the same fuel that we expect them to export to us. But have you ever checked